Welcome to this edition of Ethical Sustainable Investment News and Analysis to Profit By. I'm Ron Robbins, an ethical investing pioneer for over 40 years, quoted in the Wall Street Journal, MarketWatch, the Globe and Mail, and numerous other media, and founder of the highly respected global ethical sustainable investing information website, Investing for the Soul. And please listen to my disclaimer statement at the end of this podcast. Now enjoy this podcast. Hello, Ron Robbins here. Welcome to podcast episode 80, published on April 8th, 2022, titled Buy These ESG Stocks, say Analysts, and presented by Investing for the Soul. Investingforthesoul.com is your site for vital global ethical and sustainable investing news, commentary, information, and resources. Remember that you can find a full transcript and links to content, including stock symbols, quotes, and bonus material at this episode's podcast page located at investingforthesoul.com/podcasts. Now, just a reminder, I do not evaluate any of the stocks or funds mentioned in this podcast. Furthermore, if you're concerned about the ESG and sustainability ratings of any stock or fund included in this podcast, check your broker's online site for such information. If your broker doesn't have this information, sign up for free with Morningstar, and you can gain access to company and fund ESG sustainability ratings. Please note that I receive no compensation from Morningstar or anyone else covered in these podcasts. Also, if any terms are unfamiliar to you, simply Google them. Now, the first article I want to talk about is titled, Which Renewable Energy Stocks to Buy Now? 3 top picks by Tezcan, Gecgil, and Investor Place contributor. Here are some quotes by Mr. Gecgil on each of the 3 companies. 1. Blink Charging. Blink Charging operates electric vehicle charging equipment and networked EV charging services. It offers over 30,000 charging ports in more than a dozen countries. Blink Charging released fourth quarter 2021 results on March 10th. Revenue increased 224% year-over-year to a record $7.95 million. Net loss widened to $19 million, or 45 cents per share, compared to $7.9 million in the prior year quarter. Cash and equivalents ended the period at $175 million. Management attributes its impressive top-line growth to increasing brand recognition for its EV charging technology. Blink sold 3,733 charging stations during the quarter, representing a 253% year-over-year increase. In addition, services revenue increased 471% year-over-year. Management continues to grow its charger network with new partners and overseas expansion as well. As with most long-term growth stories, Blink is a volatile stock. It's down almost 40% over the past year. Shares are trading at 54.7 times trailing sales. The 12-month median price forecast for Blink stock is $29.50. 2. Brookfield Renewable Partners operates one of the world's largest pure-play renewable power platforms. Its portfolio consists of hydroelectric, wind and solar energy, plus storage facilities. Brookfield released Q4 2021 results on February 4th. Revenue increased 15% year-over-year to $1.1 billion. Funds from operation increased 6.5% year-over-year to $214 million, generating a record funds from operations per unit of 33 cents. Cash and equivalents ended the period at $764 million. The company ended 2021 with an operational capacity of 21 gigawatts. In addition, it has an enormous development pipeline of 62 gigawatts. Hydroelectric power accounts for more than half of its revenue. Meanwhile, solar and wind power are expected to see further growth in coming years. Brookfield Renewable Partners stock currently offers a generous 3.1% dividend yield. Management targets sustained 12 to 15% returns annually, as well as a yearly distribution growth of 5 to 9%. This renewable energy stock is up nearly 14% so far in 2022. Shares are trading at 2.7 times trailing sales. Meanwhile, the 12-month median price forecast for this stock stands at $68. 3. Clearway Energy operates renewable and conventional energy assets. The group generates revenue from sales to local utilities under long-term fixed-price agreements. Clearway released Q4 2021 results on February 28th. Net loss came in at $56 million, down from $73 million a year ago. Cash and equivalents ended the period at $654 million. The alternative energy name has the opportunity to develop 19.1 gigawatts of renewable energy projects through 2025. Clearway invested $820 million to expand its portfolio last year. Meanwhile, management is selling the thermal business for $1.9 billion, resulting in cash proceeds of $1.3 billion. Clearway stock currently generates an attractive 3.8% dividend yield, perfect for investors looking for passive income. Management targets annual dividend growth of 5% to 8% through 2026. The alternative energy stock has returned 27% over the past year. Shares are trading at 38.3 times forward earnings and 3.4 times trailing sales. Finally, the 12-month median price forecast for Clearway stock is at $39.50. End quotes. The next article is by Danny Vena, is titled My 3 Best Stock Split Growth Stocks to Buy Now and Hold Forever. It's found on Fool.com. Here are Mr. Vena's picks and edited comments on each one. 1. Nvidia. After a 14-year hiatus and more than 2,000% stock price gains, Nvidia surprised investors on July 19, 2021 with a 4-for-1 stock split. Since then, even in the face of the recent market correction, shares of the semiconductor giant have still gained 49% since the split. What's driving those gains? demand for the company's graphics processing units used by gamers continues to increase, as Nvidia now controls 83% of the discrete desktop GPU market. Beyond gaming, Nvidia chips are the processor of choice in cloud computing and data center operations, which are accelerating as a result of the digital transformation. At its GTC conference held just last week, the company added CPUs to its arsenal in a further push into data center servers. Its strategy is bearing fruit. In the fourth quarter, Nvidia reported record revenue in 3 of its 4 major operating segments, resulting in revenue that grew 53% year over year. This was driven by gaming revenue that climbed 37%, data center revenue that surged 71%, and professional visualization revenue that soared 109%. The company is also well positioned to power the metaverse and the continuing quest toward self-driving cars with its state-of-the-art processors. Furthermore, Nvidia's record revenue of $26.9 billion last year pales in comparison to the company's total addressable market, which is expected to top out at a staggering $250 billion by 2023. The second company is Alphabet. It's been nearly 8 years since Alphabet last split its shares, but the company broke that streak in early February when it revealed plans for a historic 20-for-1 stock split, scheduled to take place in July. Since its last split on March 27, 2014, Alphabet's shares gained a whopping 410%. Google's search dominance has helped fuel these gains, with roughly 92% of the worldwide search engine market. This has helped cement the company's market leadership in digital advertising, collecting an estimated 29% of worldwide digital ad spending. Then there's Google Cloud, the third largest provider of cloud services, with an estimated 9% of the market and growing more quickly than its top competitors. Alphabet's triple threat has fueled impressive financial results. Q4 revenue climbed 32% year over year, while operating margins marched higher, pushing net income up 38%. That's impressive growth for the fourth largest company in the world, with a market cap of $1.87 trillion. Its growth is far from over, fueled by strong secular trends. Digital ad spending is expected to climb to $873 billion by 2024, while estimates for the global cloud computing market clock in at $482 billion. Alphabet's revenue of $257 billion last year still leaves plenty of room for future upside and additional market share gains. 3 is Amazon. From little acorns grew mighty oaks, and from humble online bookstores, mighty e-commerce titans evolve. At least that was the case with Amazon. And in terms of stock splits, the online retailer has gone the longest since it last paired its shares in the dot-com era, circa 1999. Since then, however, shares have skyrocketed 5,490%, leading to current plans for a 20-for-1 split. Amazon is the undisputed leader in e-commerce. While estimates vary, the company controlled roughly 40% of online sales in the US last year, with an industry-leading 8% of global digital retail in 2020. Furthermore, Amazon dominates the area of cloud computing, a space it pioneered. During Q4 2021, Amazon Web Services boasted a 33% share of the cloud infrastructure services market, controlling more than number 2 Microsoft and number 3 Google Cloud combined. I'd be remiss if I didn't mention that Amazon has quickly become a force in the digital advertising market. While the company only began to break out its results in Q4, Amazon's ads generated more than $31 billion in 2021, up 63%, and giving it the third largest share of global digital ad spending behind Alphabet and Meta platforms. This trifecta of businesses drove solid results for Amazon last year, with net sales that climbed 22%, while net income climbed 57%. Yet there are worlds left to conquer. Global e-commerce alone is worth $5.55 trillion, while cloud computing and digital advertising represent $482 billion and $873 billion respectively. When viewed in the context of Amazon's net sales of $470 billion last year, there's a long runway for growth ahead. End quotes. Now, Michael A. Gayed has posted an article on seekingalpha.com focusing on one of the leading US ESG ETFs. The article is titled iShares ESG Aware MSCI USA ETF. Key themes. Here are some quotes of his from the article. Summary. iShares ESG Aware MSCI USA ETF is one of the most popular names in the ESG space, and its assets under administration has grown at a rapid pace since its inception. It could be one of the key beneficiaries of the expected $30 trillion worth of intergeneration inheritance transfer from baby boomers to millennials. Its valuations are pricey, and it is dominated by tech names where the outlook looks mixed. The iShares ESG Aware MSCI USA ETF is a $25 billion sized product covering large and mid-cap U.S. stocks with favorable ESG ratings. Companies involved in the businesses of tobacco, defense, and fossil fuels are excluded, whilst companies involved in very severe business controversies, as determined by MSCI, too are excluded. Note that since its inception in late 2016, iShares ESG Aware MSCI USA ETF assets under administration has expanded by 3.5 times the level of SPY, which tracks the broader market, and its popularity is reflected in its valuations, which are still quite cheap. Currently, this ETF trades at 22 times price earnings, and the income component too is fairly underwhelming at around 1.16%. Also, note that tech stocks dominate its portfolio, accounting for 27% of the holdings. As noted in the lead lag report, this sector has seen a slight bounce off late on account of the Russian-Ukraine conflict and cyber attacks, but it may struggle to deliver outside gains as the Fed continues to pivot to a hawkish environment." End quotes. Now, articles for the UK investor. 1. Title: These are the best ESG brokers for sustainable investing in 2022, new research reveals. Published in London Business News, and it's by LLB Finance Reporter. The second article, title: 5 Ethical ISA Options to Invest in This Year, and that's on altfi.com, by Lisa Tetley. Well, these are my top news stories with their stock and fund tips for this podcast. Buy these ESG stocks, say Analysts. To get all the links, stock symbols, or to read the transcript of this podcast and more, go to investingforthesoul.com/podcast and scroll down to this episode. Also, be sure to click the like and subscribe buttons in Apple Podcasts, Google Podcasts, or wherever you download or listen to this podcast. And please click the share buttons to share this podcast with your friends and family. Let's promote ethical and sustainable investing as a force for hope in these deeply troubled times. Contact me if you have any questions. Thank you for listening. Talk to you next on April 22nd. And bye for now. Learn how to create a simple portfolio reflecting your personal values by taking my 1-hour tutorial. Go to investingforthesoul.com/podcasts and click the link in the right-hand column for my DIY Ethical Sustainable Investing Pays tutorial. Now, I'll mention in the podcast if I have any direct interest or holdings in companies or securities I'm talking about. Furthermore, any news, opinions, analysis, or other information offered by myself, as well as references and information to or from other external sources in this podcast, is provided as general market information and should not be relied upon and thus does not constitute investment advice. Investors should consult their own licensed investment professional before making investments. Also, I will not accept liability for any loss or damage, including without limitation any loss of profit, which may arise directly or indirectly from use of or reliance on information in this podcast. Do contact me at ronr@investingforthesoul.com. Signing off, this is Ron Robbins.